You think you're too young to invest? You're wrong, and the cost of waiting is higher than you think. Let's make the math painful. Let's say you can afford to invest $500 a month. If you start at age 22, by age 62, that portfolio could be worth nearly $1.6 million. If you wait just 10 years and start at 32, you lose over $750,000 in future wealth. That is the true compounding cost of delay. The goal today is to teach you the $100 rule, the beginner's roadmap to investing like institutional money, protecting yourself from today's biggest bubble, and hitting that millionaire mark years sooner.
Before you buy your first stock, we need a stable base. This is the rule of three. Number one, the tax advantage. You need a Roth IRA. As a young person, your income is likely lower now than it will be later. A Roth IRA lets you pay taxes today on your small contributions, so that every single dollar of profit you make over the next 40 years is 100% tax-free when you retire. No other account offers this kind of long-term leverage. Open a Roth first. Number two, kill the cancer. You cannot invest if you have high-interest credit card debt. Why? Because the 20% interest you're paying is a guaranteed annual loss that no stock market return can reliably beat. Eliminate that high-interest debt first. Number three, the safety net. You need a 3 to 6 month emergency fund in a high-yield savings account. This is your shield. When the market inevitably crashes, you won't be forced to sell your investments at a loss because you have this cash sitting on the sideline.
The best beginners invest like the biggest players. Look at Blackstone. Recently, Blackstone announced they are acquiring the $1 billion Hilltop Energy Center power plant. Why are firms like this buying boring infrastructure? Because they are betting on the single most critical asset in the 21st century: power. Every single AI data center needs massive amounts of electricity. Blackstone isn't chasing the flashy software stock. They are betting on the pipes and utilities that feed the entire system. Your strategy must copy this institutional philosophy. You don't have billions, but you have diversification, and that means owning the whole underlying infrastructure using ETFs over single stocks.
This is the most crucial warning. The market is obsessed with artificial intelligence. Right now, the concentration of the Magnificent Seven stocks is creating unprecedented risk. NVIDIA alone represents nearly 8% of the entire S&P 500. Let me give you some historical context. Back in the year 2000, before the dot-com bubble burst, the 10 largest stocks only represented about 20% of the S&P 500. Today, the Magnificent Seven alone make up nearly 30%. This kind of concentration is a massive risk signal. If you bet everything on one hyped AI stock and it corrects, your entire portfolio gets wiped out. You must own the entire ecosystem. This is where your $100 per month rule wins.
Now that you understand the risk, we have to talk about the final biggest enemy of every beginner investor: your own psychology. The market is designed to exploit your emotions. When prices are high and everyone is talking about AI, your emotion is greed. You feel like you need to jump in with a huge lump sum to catch the ride. When the market drops 20% overnight, your emotion is fear. You feel like you need to panic sell everything to stop the loss. Wall Street analysts call this volatility. We call it the emotional trap. Your goal is not to try and time the market. Your goal is to eliminate emotion entirely. You do this with discipline. This is the $100 per month rule. By automating your investment to the same day every month, regardless of whether the market is up or down, you disconnect your human anxiety from the math of compounding. You remove your ability to panic. You are not gambling. You're building an empire over decades. Your primary job is simple: be consistent, stay disciplined.
With that mindset, let's look at the portfolio that lets you execute the strategy based on dollar-cost averaging. Start with $100 a month and build the habit. Here are the only 3 funds you need. 80%, the core U.S. market. This is your bedrock.
Funds like VTI, Total U.S. Market, or VOO, S&P 500, own thousands of companies from the biggest tech giants to the smallest power utility companies. They capture the entire growth of the American economy, including the power plants Blackstone is buying. This is your foundation. 10% international exposure. You don't want to rely only on the U.S. economy. Funds like VXUS, Total International Stock, give you exposure to markets in Europe, Asia, and other growing regions. This protects your portfolio if the U.S. market slows down. 10% aggressive bet, your fun money. If you are extremely bullish on a sector, you can dedicate a small 10% slice to a hyper-specific sector ETF, like one focused on semiconductors or clean energy. But remember, this 10% is where your risk lives. You invest your $100 a month into these funds every month without fail. You focus on the long-term math. By managing your risk, you get the benefit of the AI boom without carrying the single stock risk that is currently scaring Wall Street.
The decision you face isn't between getting rich and staying poor. It's between compound growth and the cost of delay. The math is clear. Start your $100 a month rule today. Now, I want to hear from you. What is your biggest fear when it comes to starting to invest? Did you invest in single stocks or ETFs first? Are you concerned about the AI concentration risk? Drop your answers in the comments below. I'll be reading every single one. Subscribe for more math-based finance strategies. I'm Liam James, and I'll see you in the next video.